Today, we're going to talk about something that challenges the most fundamental rule of personal finance. I mean, we've all been taught to play it safe, right? To spread our risk across dozens, maybe even hundreds of investments. It's dogma. It's written in every textbook. But what if that advice isn't just conservative? What if it's the very thing that's holding you back from real wealth? What if the path to an extraordinary life isn't paved with safety at all, but with extraordinary, concentrated risk?
So, let's set the scene. The date is December 23rd, 2008. That's 2 days before Christmas. The global economy isn't just slowing down, it is in a complete, terrifying freefall. Lehman Brothers? Gone. Bear Stearns? A ghost. The credit markets, the very lifeblood of the entire system, they're frozen solid. It honestly felt like the end of the world. And in an office somewhere in California, one man is watching his entire life's work just burn to the ground.
And that man, of course, is Elon Musk. Now remember, after selling PayPal to eBay, he walked away with a massive fortune, $180 million. But now, just 6 years later, almost all of it is gone. It's been absolutely incinerated in the furnace of two massively ambitious, and at this exact moment, massively failing, startups. He has just $40 million left to his name. That's it. It's all he has.
The pressure was just immense. I mean, think about it. On one hand, you've got SpaceX, his dream of colonizing Mars. It had failed to reach orbit not once, not twice, but 3 agonizing times. The debris of his ambition was literally scattered across the ocean floor. And then on the other hand, you've got Tesla, his vision for an electric future. It was hemorrhaging $4 million a month, totally unable to deliver its cars at scale. The media was calling him a failure, investors were running for the hills, and he was in the middle of a brutal divorce. He actually said later that he would wake up and taste ash. So he faces this binary choice, right? One that just spits in the face of every single financial advisor on the planet. I mean, conventional wisdom is screaming, protect what's left, split the risk. Put $20 million into Tesla, $20 million into SpaceX. Maybe, just maybe, you can save one of them. But Musk, he understood the brutal math of building something from nothing. He knew that for dreams this big, there's a minimum amount of fuel you need just for liftoff. And he knew that if he split the money, both companies would die, starved of capital just inches from the finish line. 40 million divided by 2 equals 0.
So, he didn't diversify. He didn't hedge. He didn't seek safety. He went all in. He took every last dollar. We're talking his rent money, his living expenses, everything. And he poured it into a single, desperate funding round just to save Tesla. He was staring into the abyss of total ruin. A single field component away from complete personal and professional annihilation. He put all his eggs in one basket, and then he stood over that basket with a flamethrower to defend it. And that decision, that single moment of extreme concentration, that's why he became the wealthiest person on Earth.
Musk's story is really the perfect way to start dismantling this huge lie that you've probably been sold about money. We're going to look at this powerful, pervasive idea that safety is the ultimate goal, and how that idea really just functions as a machine that manufactures mediocrity. Think about it. From the moment you opened your first savings account, you've heard the cheerful advice on the left. It sounds so sensible. It feels safe. Wall Street even calls it the only free lunch in finance. But then you listen to the people who have actually built empires from scratch. Mark Cuban says diversification is for idiots. Andrew Carnegie famously said, the great secret of success is to put all your eggs in one basket and then watch that basket. And Stanley Druckenmiller, a legend who averaged 30% annual returns for 30 years, he called diversification probably the most misguided concept everywhere. So what is going on here?
Well, here's the open secret of the wealthy elite. There are 2 different financial games being played. Game 1 is the one they sell to you. It's a game of fear. It's built around diversification, preserving whatever capital you have, and let's be honest, achieving an average return. It's a strategy designed for not losing. But game 2, that's the one they play themselves to build their fortunes. It's a game of conviction. It's about concentration, about finding these asymmetric bets where the upside is like 100 times the downside, and then betting big. That's the strategy for winning.
So where did this obsession with diversification even come from? Well, the story starts back in 1952. A 25-year-old grad student named Harry Markowitz had this mathematical epiphany. He proved that if you combine assets that don't move in perfect sync, like, say, an umbrella company and an ice cream company, you can actually reduce your overall volatility, your risk. He called it modern portfolio theory, and it won him a Nobel Prize. And Wall Street absolutely loved it.
Why? Because it turned the messy art of investing into a clean science. It gave them a product, safety, that they could package up and sell to the masses. Don't try to beat the market, they preached. Just own the market.
But there's a hidden flaw in this beautiful math. Modern portfolio theory doesn't just reduce risk, it mathematically guarantees an average outcome. See, when you buy an index fund, you own the next Apple, sure, but you are forced to also own the next Sears. You know, the stagnant dinosaurs, the companies that are quietly spiraling toward bankruptcy. The winners pull you up, the losers drag you down, and you end up right in the comfortable, unremarkable middle. If you'd invested $10,000 in a diversified portfolio back in 1986, you'd be comfortable today. But if you'd done what Bill Gates did and concentrated that into his singular vision for Microsoft, well, you'd be an empire.
Warren Buffett's partner, the brilliant Charlie Munger, had the perfect term for this. He called it diversification. He said it's the nonsensical act of adding your 20th best idea to a portfolio which only serves to dilute the returns of your absolute best ideas. But you know what the ultimate irony is? It comes from the father of MPT himself, Harry Markowitz. When it was time for him to invest his own pension, did he run his complex, Nobel-winning formulas? Nope. He split it 50-50, stocks and bonds. And his reason? His stated goal was to minimize future regret. He wasn't optimizing for wealth. He was optimizing for a good night's sleep.
And that leads us to a pretty fundamental choice. Because if diversification is for people who want to sleep well, concentration is for people who want to eat well. And this requires a different, much more aggressive philosophy, one that Wall Street has a pretty derogatory name for, the philosophy of the pig.
Just look at this legendary trade from 1992. Stanley Druckenmiller, who was working for George Soros at the time, spotted this massive crack in the global financial system. The British pound was pegged to the German Deutschmark at a rate that was just artificially high. The economies were going in different directions, and he just knew the peg was going to break. So he goes to his boss, Soros, and says, "Hey, I want to bet $1.5 billion against the pound." It was a huge bet, but Soros just looks at him and teaches him the lesson of a lifetime. He says, "If you are right on this, you can't own enough. This is a once-in-a-generation trade. Go for the jugular." So they didn't bet $1.5 billion, they built a $10 billion position. This wasn't investing, it was warfare. And in a single day, they broke the Bank of England and made $1 billion in profit. This whole experience led Druckenmiller to completely reject that old Wall Street saying. For him, being a pig means having the courage of your convictions. It means when you see a fat pitch, a situation where the odds are just overwhelmingly in your favor, you don't take a small position, you swing for the fences. The key here is redefining what risk is. See, risk isn't volatility. Risk is being wrong. If you've done the work and you have near certainty that you're right, then diversifying away from that idea isn't reducing risk, it's just reducing your profit.
Now, you might be thinking this is all just some cowboy philosophy, but there's actually a mathematical formula born from information theory at Bell Labs in 1956 that proves it's the optimal way to build wealth. It's called the Kelly criterion. It's a simple but really profound formula that tells you exactly what percentage of your capital to bet on a specific outcome to maximize your long-term growth rate, all based on the statistical edge you have. Let's use a super simple example. Imagine I have a magic coin, and I know for a fact it lands on heads 60% of the time. I offer you an even money bet on every single flip. Now, a typical diversified investor, terrified of loss, might bet, 1% or 2% of their money? But the Kelly criterion says that to maximize your wealth, you should bet a whopping 20% of your entire net worth on every single flip. That sounds absolutely insane to a financial advisor, but mathematically it is the optimal path to riches. Betting any less is just leaving money on the table. And this just brilliantly illustrates why a core part of diversification, portfolio rebalancing, is so destructive to wealth creation. Rebalancing forces you to sell your best performing assets as they grow. You're cutting your flowers. And then you use that money to buy more of your losers. You're watering your weeds. It's an active bet against the very momentum that creates fortunes in the first place. It is the mathematical opposite of the Kelly criterion, an act of wealth destruction that's disguised as prudent risk management.
But look, we have to be brutally honest here. This path of concentration is a razor's edge. For every Elon Musk who survives, for every Soros who breaks the bank, there is a graveyard of ambition filled with people who bet big and lost everything. Back in the 1970s, the Hunt brothers were among the richest men on earth. They were terrified that rampant inflation was going to destroy their oil fortune, so they didn't just buy some silver as a hedge, they tried to buy all the silver. They bought bullion, they bought futures contracts, and by 1979, they had cornered the market. They controlled nearly 2/3 of the entire global private supply. And the price? It exploded from $6 to over $50 an ounce. They were being pigs and they were feasting. But they forgot one crucial lesson. When you get big enough, the game fights back. The government and the commodity exchanges, they panicked. They changed the rules mid-game and declared liquidation-only trading. The price collapsed instantly. A $100 million margin call came in and they were bankrupt. They lost it all.
This is the dark side of concentration. This is ruin risk. A diversified portfolio can have a bad year, even a terrible decade, but it almost never goes to absolute zero. A concentrated portfolio absolutely can. The story of Elon Musk is so seductive, but it hides a massive survivorship bias. For every person who bets the farm and wins, there are thousands of forgotten stories of those who made the exact same type of bet and lost the farm for good.
So, how do we solve this paradox? It seems like concentration is both the path to incredible wealth and the path to total ruin. Well, the solution is to realize that you shouldn't be playing just one game. Your financial life has two distinct phases, and they require two completely different strategies. Okay, let's break this down. Phase 1 is the creation phase. This is Bill Gates in 1986 pouring every single ounce of his energy and capital into one bet, Microsoft. Your goal is alpha, to dramatically beat the market. Your strategy, by necessity, has to be concentration. You take calculated asymmetric risks. You bet on your highest conviction ideas. Then, if you win, you enter phase 2, the preservation phase. This is Bill Gates today. He's already won the game. His goal now is safety. It's about not losing what he has. So his strategy is now, correctly, diversification. He systematically sells his Microsoft stock to buy land, bonds, stakes in hundreds of other companies. He doesn't need to turn 100 billion into 200 billion. He just needs to make sure it never becomes zero. In this framework, it reveals the two greatest mistakes people make. The first, and by far the most common, is using a stay-rich preservation strategy to try and get rich. If you're young, with little capital, and you're investing like a retired billionaire, you are trapping yourself in mediocrity. The second mistake, the more tragic one, is the one the Hunt brothers made, staying in the get-rich creation phase for way too long. They'd already won. They had more money than their family could spend in 100 lifetimes, but they kept gambling the entire empire, and they lost it all. So this brings us to the final crucial question you have to ask yourself. What game are you playing right now? Are you optimizing to sleep well, minimizing regret with a safe, comfortable, average return? Or are you playing to eat well, accepting the terrifying risk of ruin for that slim chance of extraordinary success? Look, the financial system is designed to shepherd you toward that first option. But the world we live in, the technologies we use, the progress we enjoy, it wasn't built by people who hedged their bets. It was built by people who found a basket they believed in, put every single egg they had into it, and then watched that basket like their lives depended on it. Because they did.